Hello, and welcome to another episode of Konichi Value, where I discuss the latest news and analysis on the world of finance in Japan. Today I'm trying out something new. I'm trying to do a new format that fits very well here, where I go through a company or real estate or some other investment or just news about Japan that might be super interesting and dig a little bit deeper to get some good insights and some recommendations. Hopefully, you really like it. But even if you hate it, please leave a comment or subscribe to me or like or dislike because I really need to know if this is good or bad. But without further ado, I want to talk about Rakuten, as you can see on this side. Rakuten to me is a very fascinating company. It's one of Japan's most successful IT companies, but it has had a rough couple of years. As you may know, Rakuten Mobile has been in the red for more than 2 years, or 9 consecutive quarters to be exact. And with a cumulative deficit of around 520 billion yen and debt of over 2.5 trillion yen, the company is in deep doo-doo. That's first of all an outrageous amount of money and a clear sign that something is not right within the company. And that thing is Rakuten's mobile division. Rakuten's mobile division was introduced with a bang, offering bargaining prices and promising to disrupt the mobile market in Japan. But as it turns out, this has been a disaster. The cost of building these base stations all around Japan and renting KDDI's communication network has resulted in a massive deficit, and the company has run out of money with no vendors willing to promote it. To make matters worse, the company's own technology consulting arm, Rakuten Symphony, has been cut off from future funding. And 30% of his staff has already left voluntarily or been terminated. This is the debt right now compared to the equity. And as you can see on the graph, it's already 485% in debt to equity ratio. This is just the cost of building out Rakuten's mobile network. And even though the network is almost done, the cost just keeps on increasing. To top it all off, there has been recent reports of abusive practices towards employees, including mandatory referrals for Rakuten Mobile or risk of termination. These practices do not only harm the well-being of the employees, but also reflect poorly on the company's reputation. It is deeply troubling and indicative of a larger problem within the company's management and culture. You see, the thing is not all bad with Rakuten Mobile though. Rakuten Mobile actually did disrupt the Japanese market. And with the company's divisions pushing hard to be the cheapest company in the Japanese mobile space, they have gone from prices that used to be 1,000,000 yen or 10,000 yen to around 2,000 to 3,000 yen, depending on what contract you have. The groundbreaking 0 yen plan that the company used to have to lure in customers, which they succeeded with, has now been discontinued. And in addition, a lot of other companies have come into the sphere and lowered their prices themselves. These companies are all either run directly or indirectly by the bigger players with already built out base station and basically only maintenance costs to keep these new projects going. I think that with Rakuten's subpar network so far, where many people are complaining that they can't get reception outside of the big cities, it's going to be very hard for Rakuten to keep on growing. Despite all this, it's very important to note that Rakuten's other businesses are in the green. The company's financial services, such as Rakuten Card, Rakuten Securities, and Rakuten Bank, are doing particularly well. And the demand for online shopping has only expanded due to the global pandemic, with Rakuten being one of Japan's main beneficiaries. But the crazy thing is, even with this, the deficit problem of Rakuten Mobile is so serious that it cannot be covered by the surplus of other businesses. So, in the light of these factors, I urge all investors to exercise caution considering selling the Rakuten stock. The future of Rakuten Mobile is uncertain, and the company's increasing debt level raises concerns about its ability to weather the current interest rate environments. The abusive practices towards employees, and these are engineers, people that are really hard to find and hire, that are now forced to be salesmen, something most engineers are bad at. And the rumors of a failing technology consulting arm, Rakuten Symphony, with its so-called Open RAN technology, and other investments, makes it look very bleak for the company. As a last thing, I want to say that Rakuten will still probably be around for a while at least, even if they do nothing. Because they're spinning off their banking division, and that part is going to generate a lot of money for the company. So that even though they will be in the red for a while to come, they can still weather the storm. However, again, if the mobile division doesn't improve substantially, I don't see much of a future for the company. And no investor should risk their money to invest in something that may be successful. There's so many other companies out there that are better suited for the future than Rakuten, and I think those are a better investment to start with. And that's it for today's episode. It's a bit rushed. I'm just trying it out, so please don't be too hard on me. But if you like it, please like and subscribe. And make sure to go into konichivalue.com if you want to have more analysis like this and all my latest and greatest news and investment advice on Japan. This is Konichivalue signing off. Goodbye.